As promised, we're connecting with the management of Ramkrishna Forgings. We've got Lalit Khetan, who's now joining us on the show. Good to have you on board. Now, given the fact that we've seen the North American Class 8 truck production outpacing new orders, it's running at an annualized run rate of about 345,000 units. What is the outlook when it comes to Class 8 truck ordering? Is there any risk of a slowdown, say, in incremental orders?
No, we are not looking at any slowdown in terms of Class 8, or rather, I will say all type of order, even if LCV or Class 6, Class 7. So we are into all the segment, and we are looking for a very robust growth in terms of North American market.
Okay, so you're saying that the volume growth guidance of 15 to 20% for FY24, that remains intact?
Yeah, that remains intact.
Okay. Now, you're looking at expanding the product portfolio. Which are the new geographies, which are the new verticals that you will look to diversify into?
Yeah, see, we are looking at quite aggressively in South America and Japan, which are the two new markets opening for us. Even we are into little bit of the, you can say, Eurasia zone, like country like Turkey, where the market is opening up for us. Then even in the domestic market, we are working quite good on the railway side, which is working very well for us. So these are the areas where we are looking to improve. Apart from that, we are also looking quite working on the off-highway products, which will be also margin accretive and which will add to diversification and de-risk ourselves in terms of cyclicality of the industry.
Right. Going forward, as you focus on non-automotive sector as well, what will be the share of your verticals in your revenue pie? If you could just give us a ballpark estimate.
Yeah, so we are looking to improve it from current non-auto 22% to 30% in next 2 year time. So 70-30 should be the mix in next 2 year time for the auto and non-auto.
Okay. The capex for cold and warm forgings, is that on track, and by when is it likely to get commissioned? And will this be through internal accruals or would it be via debt?
No, it will be a mix of internal accrual and debt, but it's on track, and it will be commissioned by Q1 FY25, and it is backed by fully a 7-year order for the production. So we are also in a hurry to get this project on stream as early as possible, because we are keen to start our foray in cold and warm forging.
Okay. 40% of your revenues come in from exports. What's the export order book outlook like? And, we understand you've also been receiving a lot of orders, like you earlier as well alluded to, from Europe of late. So give us a, in-depth color on what exactly is happening with exports.
This is a continuous process. We are working with export customers, with our existing client and with the new clients. And see, there are a humongous amount of opportunity all over. So we are working constantly, and we are focused on increasing content per vehicle with each of our customers and adding customers. So we will continue to work in this direction, and we hope my export book will grow further and constantly. I think we are looking certainly to outperform the market in terms of growth in our exports as well as domestic both.
And can we see your margins as well improve from the current levels on the back of the rising utilization and the falling freight costs?
See, certainly margins are going to improve as there will be more economy of scale and more product mix is improving. So we are looking to at least 100 to 150 basis point improvement in terms of margin in next 2 year time.
Good to have you on board then. Thank you so much for joining in and giving us a view on how business is shaping up.